We're talking about the correlation between currencies and commodities like oil and gold with Brian Dolan. He is the chief currency strategist for Forex.com. Brian, thanks for being here.
Thanks for having me, Tim.
So how do we look at correlations between currency and commodities? What does it tell us as a way to make trading decisions?
Well, basically, the primary thing you need to be aware of is zero interest rates for the U.S. dollar, and that is one of the main drivers here for the overall commodity and dollar correlation. And as long as there's no movement on the interest rate front there, and as long as the economic data continues to come in relatively upbeat, we're looking at a pretty straightforward play of risk on, and that helps to support the commodities. So there's going to be a very strong correlation between the stock market, the commodities, and a negative correlation then to the dollar. So what we look at, on an intraday basis is how the commodity currencies are generally moving, and obviously they're going to respond as well to their own individual drivers, such as whatever the RBA, for instance, has to say about the Australian dollar or interest rate outlook in Australia, what the Canadian and the Bank of Canada has to say about the Canadian dollar. But generally speaking, as long as this economic recovery is still sort of bumping along and moving forward, there is tremendous demand still out there for the commodities, and this is seeing a risk positive appetite developing. So that's a negative for the dollar, positive for the Aussie, the Canada, and the Kiwi.
Now, one of the things that you've talked about is the fact that a lower dollar may lead to inflation in the commodities, and yet the Fed has said they see no indication of inflation, but we have gold reaching record highs here. What do you think is going on there?
There's a major disconnect there, and the important thing to look at with the gold is that it's appreciating not only against the U.S. dollar, it's also appreciating against in other currency terms. So gold is higher in euros, it's higher in Australian dollars, it's higher in the British pound. So it's this fear among investors that fiat currencies, paper money, is being devalued by the massive fiscal stimulus and the massive deficit borrowing that's going on by the major economies. As well, it's got its own speculative dynamic too. You break above certain levels, gold is an incredibly illiquid market, and you break above certain levels, and a lot of people have faded that move based on exactly what you said, a lack of inflation. So your two main drivers for gold are generally the inflation outlook, and then either a loss of confidence in the dollar, or in this case, a broader loss of confidence in all paper money.
Now, we see at the gas pumps, we feel the increase in oil prices eventually.
Yep. Gold,
maybe not so much unless you're in the jewelry business or directly involved, but when do we see that actually translate into the grocery store where maybe grains and other things start to increase with it?
Well, that is going to be much more of a function, and gold is sort of broken off. So that higher grocery prices, that's going to be a function of energy and overall commodity prices. Gold is definitely outdistanced the other commodities in that regard, and that's why I think I truly believe there's a speculative Waterloo coming in gold. I've never been a gold bug, but that hasn't stopped it from going above $1,100 an ounce. As Dennis Gartman likes to say, you can't spend it and you can't eat it. So what is it good for? And so this gold thing is only going to go on for as long. And here's the sustainability of the trade. It's only going to go on as long as the deficit spending is in place, and that unfortunately does look like it's going to be continuing for several more years.
What are your thoughts finally then about the government saying it has a strong dollar policy, yet letting it weaken to make our debt seem a whole lot less?
Right. I think they do. Obviously, we do need a strong dollar. We do need to have a value to the dollar that is not going to, or that is going to attract foreign investors. It's going to allow people to buy our debt. At the same time, they don't want to necessarily see it appreciating. They don't mind a slightly weaker dollar and or a weakening dollar. And this is the biggest risk for the whole dollar trade, is that it's just a slow grind lower. What they don't want to see is a precipitous 5 to 10% in a week to 2 weeks decline in the dollar. That then becomes destabilizing the financial markets overall, upsets the prospects for any kind of a global recovery. But right now, I think they're perfectly content to see the dollar basically remain weak, and with interest rates at zero, there's very little they can do behind that. So until we start to see some movement from the Fed, expect the dollar to remain on the soft side.
Brian, thanks for your time.
Thank you, Tim.